Hi, this is the business guy, the CEO of Asset Protection Planners, and today I want to discuss how to use LLCs to own and protect your real estate. As homeowners and real estate investors, our top priority is ensuring that our assets are safeguarded, especially given the numerous attorneys out there eager to seize a portion of your hard-earned assets. The primary tool we use is the LLC, and I'll explain why it's essential. And I became friends with a famous public speaker on real estate investing as well, and he was on TV all the time, so if I said his name, you might know him. Really worked himself to the bone, worth $18 million in his 20s, but what he didn't know was asset protection. Now, before I met him, he put all of his properties into one company, got into a hairy lawsuit, and the lawsuit took everything. I mean, everything, since he had all of his eggs in the same basket. If he had everything in separate LLCs, the lawsuit against one property wouldn't have taken all of them. He had to file bankruptcy. This guy was wiped out down to zero because this one lawsuit took him down. Contrast this with my client who put each rental property into a separate land trust and a separate LLC as the beneficiary of each land trust. We put his house into a land trust for privacy of ownership, and we set up a Cook Islands Trust and LLC for his liquid assets. One of his tenants got careless and put the back of his couch under a second-story window. Somebody climbed up on the couch, leaned out the window, and then fell down and hurt themselves. Now, this person who fell out the window had too much to drink, and naturally, they don't take responsibility for their own actions, right? They look for somebody to sue. So they sued him for more than his liability insurance coverage. And once that lawyer found out that he had all of his assets locked up, we even had equity stripping liens on all of his properties, including the house where somebody fell out the second-story window, they settled for the insurance limits and left our client alone. If he had all of his property in his name, he could have lost all the properties, like my public speaker real estate investor friend. So my client's structure was so robust that it was nearly impossible to trace his ownership, let alone take anything. So I'll show you how you can achieve the same level of protection with your real estate, setting up LLCs in compliant jurisdictions, minimize tax consequences, and allows for periodic transfers of real estate without triggering taxable events. Now, the brick wall here of your LLC provides two forms of protection: inside protection and outside protection. Inside protection shields you from liabilities from within the LLC, where outside protection guards your personal assets from external claims. For example, you own a property through an LLC and somebody gets injured on that property, the liability is confined within the LLC. Conversely, if you are personally sued, say due to a car accident, and all of your assets are in your name, you become a target for creditors. States like Delaware and Wyoming offer superior charging order protection, preventing creditors from seizing your LLC interest directly. Imagine you have an LLC in California, but live in Texas. California doesn't offer strong outside protection. So by owning the California LLC through a Texas LLC, you benefit from Texas's robust charging order protection. So this ensures that if you're sued personally, your California LLC remains protected. Anonymity is another critical aspect. States like Wyoming and Nevada provide for anonymity for LLC owners, making it difficult for potential litigants to trace assets back to you. For example, we serve as nominee managers, officers, and directors for thousands of entities, keeping our clients' names off the public records. Now, we can register an LLC formed in one state, so it can do business in another state, and that's called foreign qualification. So we can register an LLC formed in, let's say, Wyoming, so it can do business in California, Illinois, New York, or Florida. So when deciding where to set up your LLC, consider the property location and the protections offered by the state. For example, if your property is in Florida, setting up a Florida LLC might be the thing to do. However, you can still achieve protection by layering ownership through an LLC in a state with strong protection, like Wyoming. Okay, now let's talk about taxation. LLCs offer flexibility in how they are taxed. You can choose to be taxed as a corporation, a partnership, a disregarded entity, or an S corporation. Each option has different tax implications for your tax returns and asset protection strategy. For example, a disregarded entity's income and expenses flow directly to the owner's tax returns, simplifying tax filings. Conversely, treating an LLC as a partnership provides a buffer as the income flows through the partnership return first, reducing the visibility of individual properties on one's personal tax returns. So having a partnership like a husband and wife owning an LLC might reduce the chance of an audit because most of the detailed tax information is on the partnership LLC's tax returns. Now, very important, it's crucial to match your LLC's tax status with your operating agreement to ensure legal protections are upheld. For example, a client of ours had an LLC with a very juvenile operating agreement that offered no real protection. So properly drafted operating agreements are vital to maintaining the LLC's protective benefits. Now, this is not a do-it-yourself project where you could try to save a few bucks that end up costing you millions in the end. So make sure that your LLCs are set up professionally. Now, back to our prior illustration, when grouping properties into LLCs, consider the equity and the risk. For example, if you own 3 properties with varying levels of equity and profitability, you might group them to balance risk and protection. So avoid putting high equity properties in the same LLC as higher risk properties to minimize potential losses. And for crying out loud, do not mix safe assets with dangerous assets. You will never own a car in the same LLC that owns a piece of real estate. That'd be crazy. Get into a wreck with a car, they can take everything that LLC that owns the car owns, including the real estate. Finally, transferring properties into LLCs should be done cautiously. Direct transfers can trigger mortgage acceleration clauses if the property has debt. So that's why we illustrate here using land trusts. And that can prevent banks from calling the loan due because of the Garn-St. Germain Depository Institutions Act of 1982 protects you. So you can put a house into a land trust while you're the beneficiary of the land trust, and the bank cannot call that loan due as long as it's between 1 and 4 dwelling units. Then on a separate piece of paper, you simply assign the beneficial interest in the land trust to an LLC on that private document. So when a lawsuit comes knocking, you show both the land trust and the assignment of beneficial interest over to the LLC. Okay, so let's dive deeper into each of these concepts, starting with the basics of LLC formation. An LLC, or limited liability company, combines the liability protection of a corporation with the tax benefits and flexibility of a partnership. I remember back in 1994, I wrote one of the first books on LLCs, and there was a transitionary period there when the IRS began accepting LLCs as partnerships and sole proprietorships instead of corporations. So this makes it an ideal structure for real estate investors. The LLC protects your personal assets from business liabilities, ensuring that if something goes wrong with your property, your personal assets remain safe. Now, why is jurisdiction important? Not all states are created equal when it comes to asset protection. States like Nevada and Wyoming and Delaware are known for their strong asset protection laws and favorable business climates. They offer charging order protection, which prevents creditors from seizing your LLC interest directly, and instead, they can only place a lien on distributions, which you control. So you don't make any distributions out of your LLC, and your opponent gets zippo. Nothing, zero. And so your money piles up safely within your LLC, and this discourages losses because creditors know they might not get anything out of it. However, simply forming an LLC in one of these states with very protective laws doesn't automatically grant you the protections if your property is in another state. For example, if your property is in New Jersey and you form an LLC in Wyoming, you must register that Wyoming LLC in New Jersey to legally conduct business there. Again, the process is known as foreign qualification. Might cause some of Wyoming's protections to be lost, thus it's often more practical to form the LLC in the state where the property is located and then layer it with an LLC in a protective jurisdiction for added securities. In other words, do this. Own the property in a land trust for privacy of ownership. Assign the beneficial interest in that land trust to a New Jersey LLC. Then you set up a Wyoming LLC to own all of your New Jersey LLCs. Okay, so let's talk about inside protection versus outside protection in more detail. Inside protection refers to protecting your personal assets from liabilities arising from your rental properties. In other words, anything inside the LLC and the liabilities arising therefrom is not able to get through this brick wall to take away your personal assets. When your rental property is in this LLC, for instance, when a tenant sues you for a slip and fall accident, inside protection ensures that the assets within the LLC are at risk, not your personal savings or other properties. Outside protection, on the other hand, protects your LLC and everything it owns from personal liabilities. For example, if you're involved in a car accident over the weekend and somebody sues you personally for more than your insurance coverage, outside protection ensures the assets within the LLC are protected from this outside personal liability. So your LLC and everything inside of it is protected from an attack against you personally. That's where charging order protection comes into play. States with strong charging order protection protect creditors from seizing your LLC interest directly, providing a robust layer of outside protection. Now, anonymity. That's another critical factor in asset protection. By keeping your name off the public records, you make it harder for potential litigants to find out what you own, thereby reducing the likelihood of a lawsuit. States like Wyoming and Nevada offer the ability to set up LLCs with nominee managers or officers who appear in the public records instead of you. So this creates a veil of anonymity that can be a powerful deterrent against lawsuits. Now let's go ahead and delve into taxation. One of the significant benefits of an LLC is the flexibility in taxation. Now by default, a single member LLC is treated as a disregarded entity, meaning its income is reported directly on the owner's tax return. A multi-member LLC, on the other hand, is treated as a partnership, filing a separate tax return and issuing K-1 forms to its members. However, you can also elect for your LLC to be taxed as a corporation or an S corporation, depending on your financial strategy. Choosing the right tax status for your LLC can have significant implications for your overall tax liability and asset protection strategy. But by and large, those who own real estate having it taxed as a disregarded entity or treated as one for tax purposes or a partnership tends to be the most favorable tax status for real estate investors. For example, treating your LLC as a disregarded entity simplifies tax filing, but might expose you to greater audit risk because all of the income and deductions flow directly onto your personal tax returns. However, a multi-member LLC files its taxes on a 1065 form and it issues K-1s to the partners. This can therefore provide a buffer as the income flows through a separate partnership return first, reducing the visibility of individual properties on your personal tax returns. Now, proper structuring of your LLCs can also help avoid double taxation and maximize tax benefits. For instance, you may set up a management company that handles all of the administrative tasks for your LLCs and pays you a salary. In fact, this one LLC can collect all of the rent from all of your properties, just like you're hiring a separate management company to manage all of your properties. Your own LLC can serve that role. So this simplifies your life because all of these LLCs down here don't have any bank accounts at all. All of the money flows through to this LLC, and you use accounting software to determine the income and losses from each individual property. This can also create extra layers of protection by separating management functions from asset ownership. Now, when it comes to grouping properties into LLCs, a common question is how many properties should go into one LLC. So this decision depends on various factors, including the value of the properties, the equity of each property, and your risk tolerance. For example, if you own multiple properties with significant equity, it might make sense to put each property into a separate LLC to minimize the risk, and that's what we usually recommend. Conversely, if the properties have lower equity, it might be okay to group them together to simplify management and reduce administrative costs. For example, we had a client who had multiple raw land parcels worth between $8,000 and $25,000 each, and I don't have a problem putting a bunch of those into one LLC. But if you have 3 properties here with $300,000 of equity each, we're putting each of those into 3 different LLCs. Now, critical consideration in transferring properties to LLCs is avoiding the due on sale clause. Most mortgages have a due on sale clause, and this allows the lender to demand full repayment if the property is transferred. So to avoid triggering this clause, you can use land trust to transfer the property. Again, the land trust holds the title to the property, and you assign the beneficial interest of the trust to your LLC. This way, the property is effectively owned by the LLC without changing the title on the public records, thereby avoiding the due on sale clause and maintaining anonymity. Now, land trusts offer several benefits beyond avoiding the due on sale clause. They provide an additional layer of anonymity and protection as the trust's name appears on the public records instead of yours or the LLC. The land trusts can also make it easier to manage multiple properties, as you can have a single trust for each property, simplifying administration and enhancing protection. Keep in mind, the land trust doesn't file a tax return at all. So according to the IRS, the land trust doesn't even exist. You file the taxes on your personal tax returns and on the partnership's tax returns if you have a multi-member LLC. So this enhances your anonymity and protection. Finally, it's essential to maintain proper documentation and follow corporate formalities to ensure your LLCs provide the intended protections. And this includes not paying personal bills with your LLC bank account and not paying business bills with your personal bank account. That's called commingling. And that could kill your company's protection as a separate entity, because the judge could say you're treating the company like you and you like the company. Therefore, since you're treating it that way, the courts will treat them that way too and consider them one and the same. And therefore, they will share the same liability. So don't commingle. Keep accurate accounting records of income and expenses and hold regular meetings with documented minutes. Failing to adhere to these formalities can result in piercing the corporate or LLC veil. Now, this varies by a jurisdiction, but many judges will adhere and apply corporate law to LLC law. The corporate veil, that's where a court disregards the LLC's protections and holds you personally liable for its debts and obligations. So in summary, protecting your rental real estate with LLCs involves a comprehensive approach that includes choosing the right jurisdiction, structuring for both inside and outside protection, maintaining anonymity, optimizing taxation, and adhering to proper corporate formalities. So I hope this information comes as a great help to you. Thank you for coming to us for guidance, and continue to tune in order to deepen your knowledge on asset protection and to be better prepared to protect what you've worked so hard for. Subscribe or follow for more. This is The Business Guy.